Accountancy and Computer Systems at Narsimhanji College, Mumbai, from June 1986 to 2000. The co-author of various books of accountancy and financial management from FYGC to TY BCom at University of Mumbai. President of Bombay Chartered Accountants Society in 2006-7. Chairman of Accounting and Auditing Committee of Bombay Chartered Accountants Society for the period 2009-10 to 2012-13. He is the compiler of the column from published accounts appearing monthly in Bombay Chartered Accountants Journal. Member of a study group Corporate Laws Committee of ICI for drafting guidance notes on revised Schedule 6. Membership panel ICI for ICI Awards for Excellence in Financial Reporting for financial year 2010-11 and 11-12. Is a co-opted member Expert Advisory Committee of ICI for financial year 13-14. He has delivered various lectures at the various seminars, conferences, and written articles for ICAI, Bombay Chartered Accountants Society, Chamber of Tax Consultants, IFAC, NADT, etc. on subjects of accounting standards, taxation, etc. He is a director and member of audit committees of public and private companies. With this, now I hand over the charge.
Before, I think I request Bhavesh Bhai, past president, to present a memento to Himanshu Bhai.
Good evening to everyone. The chairman of the session, the other office bearers of the chamber, respected Arvind Bhai, lot of my other seniors, colleagues and friends present here. It's a pleasure to be here to talk about this subject which is actually a changing subject because it keeps on changing almost every week nowadays. Is the mic okay?
Louder.
Companies Act 2013 is a subject which does keep on changing nowadays every week, and from the last time what we heard yesterday is that before this month end, whatever is not notified, whatever is not been made effective will be made effective before the month end, all starting from 1st April 2014. So this is what the last thing what we have heard is about. And what we also heard is that the Law Ministry has also taken the permission of the Election Commission to go ahead and notify all the remaining sections as well as put all the remaining rules straight away effective from 1st April 2014. So lot of things to look forward to, lot of changes to look forward to, lot of challenges to look forward to in the next year as we start. What we are just going to do today is just discuss some of the provisions relating to accounts and audit, and this is as of today. Next week or tomorrow if something different comes, some things can change because this is based on the draft rules which are there. So some things can change, and as was done with the CSR notification and the rules, even the earlier Schedule 7 which was in the Act has been already replaced by a different Schedule 7. The government has that power now under Section 470 of the new Act. So we may see some changes maybe in the Act itself because of that delegated power which is there. This is an Act where the government has power to amend in two different ways. One power is given only up to 5 years. So if they have any sections which are going to have difficulties, they can make changes in those sections to remove those difficulties only up to a period of 5 years. So which means that this is a special permission which is taken by the government to amend the Act also, even without going to the Parliament as such. And there obviously are other amendments in the rules which can be done even without touching the Act per se which is there. So we are looking forward to several changes because of representations being made by the industry as well as the institute on various aspects, especially regarding accounts and audit as we are directly affected. So let's come to this. This is a background which you would have already known by now in the first session. What was the background of this bill? It was a 5-year plan starting from 2008, finally got over in 2013 when the Companies Bill really became Companies Act as such. You have draft rules which have been given, 98 sections have been notified, and the assent came on 29th August, more than 6 months back now, 6 phases of draft rules which have been given. This is the breakup of the Act. 470 sections, 95 definitions, 7 schedules. Less than the earlier Act, but a lot of things have been combined, and that is why you find lower number of sections. In terms of size, it is more or less the same. But this is important. Lot of law has been moved into the rules, and the word prescribed occurs almost 420 times. So you have got lot of rules which will come in, and the draft rules have not been even given for all these 416 places. It will come sooner or later for all the 416 places in the Act where the word prescribed occurs. What is also useful is that central government approval is reduced to a minimum of 15 times. Earlier it was much more, now it is only 15 times, because lot of places instead of central government approval, we only have now a special resolution, and that is why special resolution comes almost at 74 places in the Act which is there. What is disturbing is this word imprisonment which comes, or prosecution which comes combined more than 100 times. Now this is disturbing, but that has been the recent trend with the government, this particular government, that when it comes to enforcement of legislative laws or legislation, they want to now put lot of people behind bars. And what was only surprising is when this vote of account came before 2 weeks, we were actually looking forward to some budget allocation for more prisons. But there was no allocation because in service tax they are imprisoning people now, in company law they will have to imprison people, but there was no budget allocation for more prisons. Maybe they have left it to the next government to give that budget allocation.
How special prisons for business class?
I think we can even look forward to having some association formed in the prisons of professionals. So, we have got these notifications which have come. So far, these 4 notifications have come. The last one which came last week on 27th February, or before 2 weeks on 27th February, with the CSR rules which were there, and various notifications have done various things. The first one notified the Act in the Gazette, second one notified 98 sections, third one was for removing difficulties, and this is the 4th one. And there have been this 6 circulars which have come so far on various different subjects which are there in, or various sections of this new Companies Act which are there. Now circulars are obviously meant to clarify something, whereas notifications are meant to really notify or enforce something. So you can expect lot more notifications in the coming 2 weeks, less of circulars, because they are now going to more notify the sections and the rules which are there as such. What we are going to do is look at most of the things which can affect preparation of accounts and the auditor's role in that. And with that in mind, we are going to deal with only few definitions which are going to create problems for accountants and auditors per se. So let us see this definition of private company. Obviously the number of members is now increased to 200, but the condition of the 56 Act to have a restriction in the articles prohibiting invitation or acceptance of deposits has been removed. Now, lot of people believe that if this is done, automatically we can accept deposits from anyone and everyone. Now that is not so. If you see the draft deposit rules, they are again putting the same restrictions in the draft deposit rules, where they have said that no one can accept a deposit unless you have a net worth of 100 crores or a turnover exceeding some 200 crores. Those are the limits. However, they are exempting private limited companies from accepting deposits from directors and shareholders. So that is coming in the, or that has come in the draft rules. You don't now need to put it as one of the conditions in the articles of a private limited company as such. When it comes to public company, the definition says includes any private company if you are a subsidiary of another company. Now, as the new law has been structured or has been worded, if you are a private company which is a subsidiary of a public company, you will have to satisfy lot of rules of a public company, like say minimum number of directors, section 185, because all of them automatically will start applying to you though you are a private company per se. So lot of these exemptions which you otherwise would have enjoyed automatically you will have to forego if you are a subsidiary of a public company, and the definition of subsidiary company has now been extended as far as the act is concerned. Though in accounting you may have a different definition, in the act the definition of subsidiary is now an extended definition, and we'll see what that extended definition is about. When you see the definition of debentures, it says it includes any instrument evidencing a debt. So if you take any debt from anyone and you sign some instrument, it automatically falls in the definition of debenture. What that would mean is there are some other provisions of the act for debentures, like creating a debenture redemption reserve, maintaining some liquidity in a bank for redemption of debentures. Now, even if I have taken a ICD, even if I have taken an intercorporate loan, obviously you will sign something and give. Now that signature on a paper automatically is evidencing a debt, which means that that ICD automatically now becomes a debenture. This was not there in the earlier definition of the old act. So even if you now take a ICD, you may have to fulfill provisions of creation of debenture redemption reserve, maintaining 10% of the repayment due in a liquid amount and such things, which seems to be unintended, but because they are extending the definition of this debenture, it automatically covers everything. You take a hundi loan, that also is a debenture now, because there is an instrument which evidences a debt when you accept any loan as such. Turnover. The definition of turnover earlier was not there. It was earlier there in section 43 as only relating to that section when it was the section of deemed public company. But the definition of turnover from that small section has been now put right in the main section of definitions, which means now this applies across the act. And what is the definition of turnover? What is disturbing here is the use of this phrase realization of amount due. Now when you say aggregate value of realization of amount due, it literally takes you back to cash basis of accounting. Because when I have got trade receivables, it means I have sold goods but I have not realized the money. When I calculate my turnover, do I make an adjustment for that? Opening and closing trade receivables. Now that is something again we are not sure, and this is something which is going to create some issues on lot of, say for instance, whether you are a small company or not. I have to decide the turnover criteria for small company. The turnover definition will come from this, because this is now defined under the act. Though for the preparation of accounts, I will look at turnover from my accounting standards as far as the applicability of whether I am a small company. The definition this definition may need to be looked at by adjusting your trade receivables. Now this is again something we expect some more clarity by way of a circular or something, but as it stands, I mean, you may need to adjust your opening closing receivables because those amounts are not realized as such. Free reserves. The definition of free reserves, there is a proviso which states it is what is available for dividend, but the proviso says you exclude unrealized gains, notional gains or revaluation of assets, and any change in the asset or liability on measurement at fair value. Why did this come? Because India was to adopt IFRS. Now, what really happened was around 2011 or 2008 or 9, when this new drafting of the Companies Act started, obviously India also said we are going to adopt IFRS. So the new Companies Act, the revised Schedule 6 which were being drafted around that time also put into place lot of concepts which were related to IFRS. And everyone thought that on 1/4/11 everything would be introduced all at the same time, the new Companies Act, the revised Schedule 6 as well as IFRS. What happened was IFRS was left behind. But the other things have now come in with the new concepts, which are more IFRS based concepts. So you have this measurement of asset liability at fair value is clearly IFRS concept. There are several other concepts also which we will see. IFRS has still not come in, but some of these concepts have come in, which even a small company will now have to apply. But in free reserves, when you have to exclude unrealized gains, again, do I make an adjustment for receivables? Do I make an adjustment for restatement of my export debtors and creditors? Is again something which you will need to see, because when I do a mark to market for my closing export debtors, it is not a realized amount. So it is just a notional entry for mark to market. So marking it to that rate. So whether I make an adjustment for that for notional gains, if I have not realized something, I have just sold but not realized something, it's a notional gain. Do I make an adjustment for it in free reserves? Could be difficult. So today, if someone in the new act, if someone says please certify what are my free reserves, you are going to have difficulties, because you will have to go with this definition of free reserves. It is not simply adding up two figures on your balance sheet that you can now certify what is free reserves in that sense, because you may have to follow this particular definition as such. Private companies, several additional provisions applicable. We are not going to deal with them. You have a separate session on it, so we are not going to deal with them. Just a simple listing of various provisions which will now start applying even to private limited companies as such. And a lot of businessmen are actually now trying to take a call whether to continue with a private limited company without lot of these exemptions, or convert the company to an LLP, because LLP may be much easier to administer than administering a private company with after losing lot of exemptions which are there under the new act as such. So maybe they will have to decide immediately once this April comes in what they really want to do, continue with the extended compliances or convert themselves to a LLP. Let's come to the core subject per se, accounts and financial statements, 128 to 136 of the new act which is there. Few things which are just listed down here. Books of accounts can be in electronic form. You have to preserve your accounts for 10 years or longer in case of any investigation. The draft rules mentioned you have to retain them completely in the same format as originally generated. This is not a doable thing, because if you have printed something and given it to your auditors to sign and tick off, what this says is for 8 years you keep it in the same manner. Now obviously people will try and take a backup and then preserve it, not preserve it in the same manner, but the draft rule says something like this. Accounts have to be on accrual, books are open for inspection, there is a uniform year end, April to March. Only exception is for subsidiaries of foreign companies, and that too with prior approval. Otherwise everyone goes to April to March, and the MD and the CFO are responsible for complying with the above. So we are now telling a CFO who joins a new company that please take a proper handover from the old CFO and please ask him to show all the 8 years books of accounts, because you are now responsible for the earlier 8 years books of accounts also. So this is obviously the responsibility of the current CFO. So we are asking a proper handover process also now to be done for even the MD and a CFO, which normally has not been done so far. Section 133 says that central government will prescribe accounting standards, and notification came in September and a clarification that till the government issues accounting standards under the new act, the old standards notified under the rules of 2006 will continue to be followed till NFRA is formed and the new set of standards are notified.
Whether institute will discontinue giving accounting standards?
Institute will always frame the accounting standards, but even today institute only frames the accounting standards. They are finally approved and notified by NACAS. Now instead of NACAS it would be NFRA, but the institute's role will still be to prepare the raw material.
So the accounting standards will be identical?
We do not know that. I am not a member of NAFRA.
So for foreign company subsidiaries, you mentioned that they will probably follow the uniform year, otherwise they need a prior approval.
Yes.
What is the situation for branches or project offices of foreign companies, or because as a place of business they still need to report to the
Maybe for that also you will have to take permission. Otherwise, though they are not directly subsidiaries, I think you can still go and take permission to close your branch accounts on different dates. Financial statements is defined for the first time in the Act. It includes this 6 things: balance sheet, statement of profit and loss, cash flow statement, consolidated financial statements, having in case a company has subsidiaries, and subsidiary in this case includes associate or joint venture, statement of changes in equity if applicable. That is clearly a concept of IFRS. We call it SOCIE, S-O-C-I-E, statement of changes in equity, and any explanatory note forming part of the above. So financial statements will have to definitely have all these things, and cash flow statement is necessary for all companies except only for one person companies, and CFS necessary for all companies having subsidiaries. Now subsidiaries here has an extended definition which we will see what could be the implications of it. Associate company also is defined as company in which you have a significant influence, control of at least 20% of share capital, or of business decisions under an agreement. Now this or of business decision under an agreement is again a very wide concept. Say for instance, you are running a hotel under a franchise. The person who has given you a franchise is having a control of your company because he is able to take business decisions under the franchise agreement. Now does that automatically make you an associate of that company? Now that is again to be seen, because this becomes very wide, because any business decision even without a single share can also automatically make you an associate of the other company. So if ITC today, tomorrow gives that Fortune brand to run a hotel to some XYZ, that XYZ can automatically become an associate of ITC, because ITC can run some business decisions under an agreement with that particular XYZ. And subsidiary is defined to mean controlling the composition of board or exercising or controlling more than 1/2 of the total share capital. Earlier it was only equity share capital, now it is total share capital. This change comes mainly because of the 2G scam, because in the 2G scam there were some companies where the equity holding was maybe only 10%, but on preference the holdings were very high. So they have aligned to basically take care of some problem in that 2G scam, but again internationally this is not so. Internationally it is still only 50% of equity, but in India you have this definition. And we'll see in the next slide what difficulties it can create. When you prepare cash flow, which method will you follow? Direct method or indirect method? In fact, when we ask lot of businessmen, do you know how to prepare a cash flow statement? He tells us, I know what are cash flows. I do not know what is a cash flow statement. If I write my cash flows on a piece of paper, is that okay? But you have to prepare a cash flow statement either by direct